Hello everyone, welcome back from the summer break. I was not on for the last 1.5 months or so. So we are back now to the business. We have quite favorable market conditions, and basically this is what I'm going to talk about today, since the markets are really in our favor. And the latest things that are happening, although situation in all aspects economically and politically and geopolitically is worsening, but on the other side it's giving a good boost to the markets and moving markets in a quite fast way, resulting in basically it results in the increased volatility. We have just to go back to the near history from 2020, when the pandemic crisis started. If you remember, we had quite wild swings in the markets, and then trends have established, and the market simply reacting on the conditions, economic, political, all the factors that contribute, and the reactions were quite strong, and the markets were volatile during the crisis in 2020. We had some slowdown, just to go back to the corona crisis. A number of traders made a lot of money during this period. Simply, we had initially the first 1 or 2 months of the crisis, we had quite turbulent market movements with no clear direction, but later on the trends have established, and a number of traders made money, which is good. It means that they followed the rules of the market and joined the trend. Though it was, and I think I mentioned it in some of my previous presentations, the reaction of the market was not as a textbook reaction as expected. Initially it was, but then it changed. So it was a matter of traders' ability to recognize the new situation and join the market, but a number of traders that I know, and including myself, made quite good money during these things. So when the markets are volatile, when the markets are liquid and active, this is in our favor, and we like to see volatile markets. This is good to make some profits. Of course, we need to be very careful with the stops, with the all the necessary steps, risk policies, and everything that is accompanied to trading, to successful trading. As the golden rule is, minimize your losses and maximize your profits. And now, after the corona, we had a period of economic recovery and stabilization, and the markets were active, but not at that extent as it was during the corona. But then things started to become more wild after inflation started to increase. This was the late 2021 and early 2022. If you remember, the inflation was quite anemic and around zero or very low levels for a number of years after 2008 recession. And the central banks did a lot in attempts to try to revive this inflation, to push it higher, because low inflation is also not helping as much as the high inflation is not helping. So central banks always try to keep inflation somewhere around their targets, which is in average around 2%. So this is the ideal level for the central banks and for the economies to have optimal conditions to function. The inflation started increasing and rose in most of the Western economies, developed economies, above the target at 2%, and it was quite quickly kept, it found actually the most of the central bankers off guard. They were caught in unexpected action, and their initial estimation was, I would say, wrong, because most of the central bankers, starting with US Federal Reserve, saying that this is transitory, or temporary think that phenomenon that will eventually peak and start to fade. So nothing to worry. When they realized that it's not like this, it was a bit too late. When the central banks started increasing interest rates, it was a bit late because inflation already gained strong momentum and started to raise well above the target. That started to harm the economies and started to cause problems. So the US Federal Reserve was the first one to react and started pushing its interest rates initially by 0.5% twice and then 3 times in a row by 75 basis points, which is quite massive, bringing the interest rate currently to 3.25 to 3.5% range. That made the dollar very attractive for traders. The action of the other central banks was similar in a way, not that aggressive as the US Federal Reserve, and the Bank of England subsequently also started raising rates. The last increase was 0.5%. Bank of Canada, Central Bank of Australia also increased interest rates, and as well the European Central Bank, which slightly delayed. They were a bit cautious regarding the situation, keeping this in mind, in their mind, they thought that it is still transitory, it's still temporary and cannot raise that high, but eventually they realized that inflation is much higher and much more dangerous than it looked initially. So they started to move. Initial steps were to go from the negative territory because the European Central Bank had the negative interest rate, first to zero and then slightly above zero. Now they are close to the neutrality territory, which means that the interest rate is not negative to harm, but it's not positive enough to provide any significant substantial results to the economy. But the central bank said in its last policy meeting, the director Lagarde said that they are ready to use all the tools and to hike rates as much as possible, as much as needed actually, in order to start restoring the price stability. Though they are all, every decision will be made from meeting to meeting, so there will be no plans to do something before the meeting. And decisions will be, of course, data dependable. So if they see that economic data during certain period between two meetings is deteriorating, of course, then they will have more action plans to act and start increasing interest rates. Meanwhile, the inflation in the European Union hit record high at 9.1 in July and eased slightly to 8.9 in August, while US inflation reached 9.1. This is the 40 years high in June, and then eased to 8.5 in July and to 8.3 in August. The decrease from the 40-year high was supportive, was a positive, good news. But the second one, the August result, was slightly above the expectations that again warned the central bankers that inflation might not have peaked yet, which is their main target, to see the inflation peaking and starting to ease. Now they have a renewed fear that inflation might not have peaked and it may increase further. Most of the central banks have a very pessimistic outlook and they keep downgrading their forecasts for the near future. So the expectations with inflation, why I'm talking about inflation, this is one of the key things nowadays, along with the another two or three factors that nowadays move the markets, and we need to really pay a lot of attention to this to analyze, explain, and see what further impact could be expected from high inflation. And will the central banks manage eventually to put it under control and push it back towards the 2% target, as the main aim of all major central banks is to bring inflation back to the target 2% and restore the price stability. So far, we have a number of things that are fueling inflation, so it is quite a difficult job, despite their strong efforts to do something and put the inflation under control. So another factor that is causing high volatility in the market is another key thing. It's a geopolitical factor, and it's a current war in Ukraine. So as we know, Russia entered the territory of Ukraine, and the war started basically in late February this year. So we are already 5-6 months in the war, with a lot of atrocities, a lot of damage made so far, a lot of victims. But what affected the economy, apart from the standard impacts that every military conflict brings to the economies, not just to the economies of the countries that are involved in the conflict, but surrounding, and this is always sending shockwaves to the markets and to the economies. So we have strong impact from this. But what is important to mention these things are the sanctions that Western world instantly imposed on Russia, limiting a huge number of services, goods, things that were imported from Russia, banning their banks and money transfers, basically trying to disconnect Russia completely from the world. Every measure that is made as a punishment has its other side. So in this case, we had a negative impact, of course, on the Russian economy, although the latest comments from the economists from across the world say that basically they completely missed the target with the inflation, with the sanctions on Russia, and actually, let's describe it this way, made a favor to Russians, because they managed to turn their financial actions into the different other channels, establish economic connections with the other countries apart from the Western world, and continue the trading, continue the financial flows, with some damage, of course, being done. What is important is that the side effect or return effect of the sanctions on particularly European Union. European Union is was the most and is still vulnerable to these sanctions, because they are highly dependent, first of all, to a number, actually they are highly dependent to a number of goods from Russia, but number one is the energy. So the sanctions said Russian oil is banned, though in the sanctions list of the sanctions, the natural gas was somehow sidelined, and some flows of the natural gas towards Europe were active until recently. So the Europe wanted to keep Russian gas, natural gas, because this was the most important for functioning of the economies. So they managed to keep it, but during the period of war, as the things started to deteriorate and the conditions worsened, first of all, there was servicing, as Russians say, the pipeline Nord Stream 1 that stopped the flow for a few days. Then Russia eventually reduced, and now it's saying they will completely cut it unless the sanctions are lifted. So we have quite big problem with these sanctions now, and things are moving in some undesired and unwanted direction. So the shortage of gas in Europe, especially as the winter is approaching, is something that it could be disastrous scenario. As I said, the European Union and particularly Germany and France as two largest economies, and all the countries that are on the eastern side of European Union, eastern side close to the Ukraine and closer to Russia, they are more dependent on Russian gas, and they are more vulnerable to anything that could happen if flows stop completely. They make plans to restore supplies, basically to find the alternative supplies. This is a job that cannot be done within few months, so they should be fully aware of this. Otherwise, things will be much easier to be done, just to say, okay, we are restoring the things, and we are bringing new suppliers, and let's just continue as it is. But things are not like this. So we need to see something substantial change, some substantial changes that would restore sort of stability in the European Union regarding the energy components, which are the crucial. The German economy minister already warned a few times that German industry might be partially or completely stopped during the winter, depending on the depth of the crisis and how the things will be developing during these coming months. Already some strong restrictions have been imposed to the ordinary people, to the to use of the electricity, economizing gas. Things are like 1 second. I would just like to say I saw one message. Basically, this is the thing. The next slide will be charts. So I'm still talking about the fundamentals, and then we'll move to the charts. So there will be next slide will be charts. Thank you. So we have quite a big problem with this, and this is causing strong fears and uncertainty in the world, which of course reflects on markets. So as I said, the dollar was the winner, top winner in the past 9 months of this year, being up against the basket of major currencies for around almost 19% until now. So first 9 months. Subsequently, the sterling, euro went strongly down. The dollar hit 20 years high against the basket of major currencies. Euro is at 20 years low. British pound against dollar hit the record low. These are the things that are historical, that are not seen on a daily or monthly basis. These are things that happen once every certain longer period of time. So this is these are the things that are causing the strong volatility in the market and making the conditions favorable for us traders. So let's take a look at the charts, and I want to show you how it looks. Of course, since you are traders, you know how the things, but let me give my point of view of the key things that are happening, and let's see how the things will be. So we'll just move these things. I want you to see. Okay, well, the first thing we can see is just wanted to ask, do you see the chart at the moment? chart is good. Okay, so let's start with the crude oil. This is one of my favorite instruments. We had the sharp fall, monthly chart. So we had a sharp fall in during the 2020 coronavirus in early stage crisis. You remember that crude oil dropped to zero at one point, and then we had very significant recovery that resulted in crude oil peaking at $130 per barrel when the war started in Ukraine. So this is the trend on a monthly chart that lasts for over 2 years. So this is very favorable for us traders, and especially if we take, if we stick to the major policies that trend is your friend, then it's good to be with trend. Now, in past 4 months, almost full 4 months, the crude oil changed. What happened? Despite that war itself suggests that there'll be higher consuming of the oil due to the conflict because armies need much more. Then there were more important fears that supplies will be cut. And this all results in the higher oil prices, which was presented by this move and spike in February 2022. And then all of a sudden things started to change because they realized that increasing interest rates by the central banks to quite high levels automatically means that economic growth and economic activities will slow in these countries. It's simply action and reaction. If you make your money more expensive by higher borrowing costs, of course you will have less investments. Your investments in your country will be less attractive. Every process will be more expensive. So it will eventually slow the growth. Now, most of the major Western economies are at the brink of recession. They are all talking about recession, still saying that they are at the edge, at the border, or in shallow recession. Even Americans described it as a significant slowdown in the economic activity rather than recession. But this is a scenario that is very likely because the central banks are in continuous fight with the inflation, and especially U.S. Central Bank promised and said that they are going to further increase interest rates. They expected to increase to 4.4% in 2022 and to peak it at 4.6% in 2023. So it means if the interest rates are going higher, then the economic growth will slow. So fears that economic growth will slow mean that general global demand for crude oil will slow, and it will be pushing the price down. And this is the thing that we see in the past 4 months. So if we measure, let's say, a retracement of Fibonacci retracement of this entire recovery from 2022 to 2022, we have over 38.2% already being retraced, and we have quite a strong negative signal, technical signal here on break below this Fibonacci level that tells us okay, oil is down, and this sharp downtrend, when you have 4 big red monthly candles in a row, that means something. That means that trend is still down, and we had quite strong signals. Of course, if we break it into weekly or daily, things will not be like that. We will have some swings of correction, but generally trend is still down. As you can see on the chart, the price is going down. Let's move to the next, also very interesting US dollar index. This is the performance of the US currency against the basket of its major 6 world counterparts. Again, we have monthly chart. The dollar is at the highest in 20 years. We cannot squeeze it that much. However, dollar remains well supported due to the 2 key factors. As I mentioned, the high interest rates make it more attractive because if you are holding dollar, you can earn some interest on it. in comparison to the period of coronavirus crisis when all central banks brought their interest rates to zero, and there was no point of keeping the currency money in the bank because you don't gain interest. Now, this time the US central bank is increasing sharply its interest rates, and this is pushing the dollar higher. So the US dollar against basket of six major world currencies is at the highest in 20 years, tending to go further up because the fundamental conditions are still very much in favor of dollar. If we take a look, that dollar is a safe haven instrument, and conditions, political, geopolitical, economic, are quite fragile and tending to get worse, then we can expect that dollar will, on that logic, go much higher. Of course, there will be some corrections, which are usually when we make technical analysis, say that buy on correction. Correction is going to provide you better levels to buy again or to sell again, depending on the direction of the trend, or to join bullish market. So it will be primarily just brief pauses in the larger uptrend. So this uptrend lasts since May 2021, so we're talking about over 1 year period. And taking into consideration that overall factors that influence the performance of the US dollar in this case are not likely to change towards better in the near future, we can expect the dollar to go up. So when we have a trend up, then we are buying that instrument. When you have trend down, we are selling that instrument, and it's very simple. If we take even daily, let's say we have one leg higher, we had correction offering better levels, then next leg up, and this goes, if we squeeze it a bit, it goes quite long. So it's a perfect uptrend. So let's take a look, put briefly the trend lines, and we can see the channel here, which has been, I think, broken at the upside, and another bullish signal if the channel is broken on either side. This is another positive signal. So dollar, the markets generally remain volatile. Now we are in the correction. You can see on the daily basis, dollar is easing, so it's going likely to correct. And I think I wrote some comments published in FX Street about US dollar, so you can read and see. Let's see what is the next important, euro. Euro is among the top losers during the past 1 year or so, as during the coronavirus pandemic crisis, the euro benefited as traders turned more into the riskier assets, but complete risk aversion started with the crisis sparked by the war in Ukraine and all surrounding factors that followed, pushing the traders out of all risky assets, among them which is euro, and we can see that euro broke below the parity level. This is for the first time in 20 years, and this is a quite significant thing, and losing sharply levels below, actually extending to the levels well below the parity level. 95, around 95.50 is the lowest so far on the monthly chart. Of course, if we take a look at the daily, we had the past few days strong acceleration lower, so trend is clear. Technical indicators are in the bearish setup, so this gives us quite a good signal what to do. I love to see such markets, because when you see steep move in either direction, then you know that you are going to win. Of course, you need to follow this market, and you need to be with this trend. Don't go against it, because the forex market is one big dragon which is throwing fire. So for all those who do not follow the major rules of trading, this fire will likely burn them. I've seen in my career a number of traders who thought that they are smart. You cannot fight the machine which daily turns few trillion of dollars on daily basis. So with your, regardless how big is your account, you cannot simplify this. So you need to go along with them. If you cannot beat the enemy, as people say, you join them. So if you join the downtrend, it means that you are doing good things and high volatility in the market. We had the acceleration in past during the last week and yesterday. Today there is a bit of pause and other factors that come. So the factors that influence the market are just coming. Nearly every day there is something new, and what I wanted to show you, it's a British pound, again very similar to euro, but the British pound is at the lowest in the history against the US dollar. Last week it hit the lowest levels in 37 years, so since 1985. Now the latest acceleration that was seen last Friday and on yesterday when it pushed lower, it hit the historical low. So this is a big signal that something is developing. What happened? Britain is among the G7 economies the most hurt by the crisis. They had the highest inflation of 10.1. They were the first to have double-digit inflation among the developed economies. They managed to, the inflation dropped to 9.9 in August from 10.1 in July, but it's still 4.5 times above the central bank's 2% target. So it says everything. So it means that it's extremely high and the pressure on the economy is huge. Now, the new British Prime Minister said before she was announced as a new PM after a successor of Boris Johnson, and after she took the office in Downing Street 10, she said that they are going to apply the set of financial measures, fiscal measures to support the economy and more important, to support struggling households in the UK as they fight with the extremely enormously huge energy bills, gas bills, electricity bills, very high prices of food, and simply they cannot handle it. So Mrs. Truss came and said that they are going to add a new package of financial aid, help to the economy and to the households, worth double the size of the help that was provided during coronavirus pandemic. So it means that they are going again to increase their debt, which is already huge, by additional hundreds of billions of pounds. And this is again pressure on the economy. A number of economists were disagreeing with this, saying that they will just make the things worse, because simply you cannot extinguish fire with the alcohol or with the petrol. You need to take the proper measures. Although when you are between two strong forces which are moving in opposite direction, then it's quite difficult to react. But what happens, these things cause the quite strong volatility in the market and make favorable market conditions for traders, so we can always benefit from this. So if we take a look again in the monthly chart, we have steep downtrend. Of course, once the instrument entered the uncharted territory, that means that some headwinds or supports or resistances, depending on the direction, will face there, and that's what we have seen in past yesterday and today, when this long-tailed candle suggested that there is a headwind, and today's green candle. So we can expect some correction, but generally market remains very, very volatile, and the conditions in the market are very favorable for traders. And another one very interesting is gold. The gold again moved against its major let's call them rules, because the gold is safe haven instrument. So in case of any crisis, non-yielding yellow metal is usually the first one to be bought by traders. Secondly, the gold is also known as a top hedge against inflation, because again, it has no interest. In this case, we had exactly opposite the reaction of the markets. Gold went down in past 1, 2, 3, 5, 6 months. So basically, since the beginning of the war, the gold was going down. What happened? Simply the traders had to choose between a dollar and a yellow metal. They opted for dollar. Why? Because the dollar is giving an interest. So since the gold is denominated in the US dollar, obviously that if dollar is going up, the gold will go down. And we had significant downtrend in past 6 months, which is likely to extend. So if we just consult our technical analysis, we will see that first of all, there was a pattern of double top on the monthly chart. Break of that range floor, which was here, it was around 1680 zone, was additional support to fresh bears and additional negative signal. And this actually caused, let's just take entire move to be more precise. So we had 1680, the floor of the range, and we had it as a 38.2% Fibonacci retracement. So quite strong signal, bearish signal was generated here, double top, as it is a very bearish chart pattern. So we have quite good signals. If we take a look at the indicators, then we can see that momentum is very bearish, very negative on the monthly chart. The relative strength index is in the steady downtrend, though moving averages are still moving into the bearish setup. Now they are mixed, but creating bear crosses, 5 over 30, 5 over 20, 10 over 30 monthly moving average. So we have a number of negative signals, and then if we add it to the facts that economic and political situation is worsening and the outlook is quite negative in all these fields, then we can expect gold likely to go down unless substantial changes happen. But we'll have enough space and enough time to see these changes. We can see also, let's say the 1680 level was supported by 200 period moving average on the weekly chart. So another strong negative signal, giving us signals that at least from the technical, that things are going against gold, and some corrective actions that can be seen on the daily chart better than on weekly. On monthly, they are visible on the weekly. On monthly, we have a steep downtrend, so giving us just opportunities to rejoin bearish market. Of course, we need to follow all the time the fundamental front and see what's going on there, because nowadays the markets are mainly moved by fundamental things. So economic indicators, releases, geopoliticals as the key driver are key points and key factors that move the market. So we need to focus on both basically. But at this point, fundamentals are a bit more important and more significant in driving markets. And quickly, just to see what else could be interesting. Dollar against Japanese yen reached this 24-year high. 145.90 was the highest. I was just commenting it today. Japan intervened last week by buying yen, because sharply falling. Japanese yen, local currency for Japan, is not favorable for the Japanese economy. So they try to, in a way, curb that drop. Success was for the time being not something significant. The dollar remained strong against Japanese yen as long as it holds below between this range established since in past 3 weeks, let's say. We cannot say that bears are regaining control. On contrary, we can say that bulls are consolidating before resuming higher. And the Japanese yen, dollar Japanese yen is actually focusing 2008 peak at 147.68. This is still in play, the target. And the only thing that could happen if the dollar goes below this level here, this spike low, which makes the floor of the range, that would signal that bears are in defensive, and we may expect some deeper correction. But generally, a strong uptrend is still fully in play if we take a look in any chart. So any movement to the opposite direction will be still seen as a corrective action rather than a general change of the trend. So as long as the fundamentals are as they are currently, we cannot expect some significant changes in the behavior of the market, but just brief breaks in the movements, unless something happens, which could be, let's say, peace treaty between Ukraine and Russia, lifting the sanctions against Russia. That would be quite strong signals that things will change. In this case, we'll have dollar likely going down as the risk appetite will increase. We'll have stock markets surging, as well as riskier assets like euro, sterling, Australian dollar, and the gold will likely go higher. So unless such crucial things happen, very unlikely that we can see substantial changes in the market at this point. So I would like to stop here with the presentation, and I would like to ask if you have any question to ask, so I'll be very glad to answer to you. Okay, I cannot see any question at the moment. So I would like to thank you all for attending today's session. I hope it was helpful, especially for you traders, as I'm a long time in the business and have quite a good experience and can always assist with the good suggestions or advices. So in case of, if you want some more details, you can find my comments on FX Street or in windsorbrokers.com website, or you can contact me directly, and I can always give you some hints or tips, or simply teach you how to become a good trader. Also, I'll be a speaker in the Dubai Expo in a couple of weeks, so you can also see there what I'll be talking about. And you can always learn. I always learn from people who have more experience or more knowledge, or simply are more into this, and I like to ask and learn something new, because we are in quite volatile markets, and it's good always to be ready for action. But volatile markets are our favorable things, and we like it, and we are trying to squeeze as much as possible profits from the markets. Thank you again, and have a good rest of the day.